1. What is patience, and why is it important in investing? Patience means staying away from emotional reactions to short-term market fluctuations and focusing on long-term goals. In investing, patience does not simply mean waiting. It means waiting within the framework of a strategy. Historical data shows that patient investors often achieve significantly higher returns than those who constantly move in and out of the market. This is one of the fundamental principles of investing. Pushpin 2. The main mechanism through which patience increases returns. Backhand index pointing right 2.1 Compounding. Letting time work. Patience allows investors to fully benefit from compounding. Compounding occurs when gains are reinvested, generating returns on returns over time. In the short term, this effect may not be noticeable, but in the long term, it becomes exponential growth. Example: assume an investment generates a 7% annual return. After 10 years, the capital roughly doubles. After 20 years, the growth becomes significantly larger. This effect accelerates over time, making patience increasingly valuable as the investment grows at an expanding rate. 2.2 Overcoming market volatility. Financial markets are often highly volatile in the short term. Prices can experience sudden drops or rapid increases. Patient investors: do not panic and sell. Avoid realizing short-term losses unnecessarily. May see downturns as opportunities. This allows them to benefit from long-term trends rather than short-term fluctuations. 2.3 Time in the market versus market timing. Historical evidence consistently shows staying invested in the market is more profitable in the long run than trying to time the market. Missing just a few of the best-performing days can significantly reduce long-term returns, since major gains often occur during short and sudden rallies. Patient investors are more likely to capture these periods. 3. Academic and market evidence. 3.1 The advantage of patient investors. Academic studies have found that individual investors who trade less frequently often achieve higher long-term returns compared to those who trade actively. This effect is particularly noticeable in long-term stock investments. This demonstrates that patience and a long-term perspective provide measurable mathematical advantages. 3.2 The cost of impulsive behavior. Research indicates that there can be approximately a 15% performance gap between patient, disciplined strategies and impatient investors. Impatient investors typically realize losses through panic selling, focus on short-term opportunities, frequently change their portfolios. These behaviors reduce overall returns. 4. Patience and psychological factors. 4.1 Loss aversion and market impulses. The human brain dislikes losses. When markets decline, remaining patient becomes difficult. However, short-term fear often reduces long-term returns. Patience provides resistance against this emotional trap. 4.2 Patience and rational decision-making. Patient investors focus on fundamentals and long-term trends rather than daily price movements or sensational news. This leads to more rational, less emotion-driven decisions. 5. The limitations of alternative approaches compared to patience. Short-term strategies. Higher stress due to volatility. Frequent trading, higher costs. Risk of market timing mistakes. Patient strategies. Lower costs. Less stress. Maximum benefit from compounding. This shows that patience is not merely a behavioral trait. It provides a clear mathematical advantage. 6. Patience is a skill. How can it be developed? Patience is not innate. It can be learned. Practical ways to build patience. Set long-term goals. Avoid focusing on short-term fluctuations. Plan your portfolio and stick to the plan. Stay away from sensational news. 7. Summary. Why is patience the greatest return? Patience delivers the highest returns in investing because the power of compounding grows over time. It prevents panic-driven decisions during volatility. It reduces market timing errors. Patient investors statistically achieve higher returns. Impulsive behavior reduces performance. Core conclusion. In financial markets, patience is not just an emotional stance, it becomes a mathematical and psychological advantage. Historically, Long-term patient investors have achieved higher and more stable performance compared to those who engage in short-term, impulsive behavior.